do partnerships then. Again, this is from a different book. It's a PDF. It's not in Kiso, so I just put the PDF in there just so you're buying a book. So we are going to cover just formation and income and bringing in new partners. We're not doing liquidation, which is the next chapter, next part of the chapter. We're doing the first part. Okay, so it's just forming the partnership, allocating income, bring a new person in, or someone leaves. We're not doing liquidation, which is a whole new area. Okay, so let's do that. Okay, so partnerships, as opposed to corporations, they're governed by two things: the UPA, Uniform Partnership Agreement, and the partnership agreement itself, or Uniform Partnership Act. Okay, the UPA covers every partnership. It's general rules. Establishes creation, rights, obligations, contributions, indemnity, just general legal stuff every partnership should follow. So indemnity, what does that mean? That means if one partner goes out and gets a loan, the other partners will hold him harmless because he's one of the partners. So they can't blame him for getting a loan if he's doing it for the partnership. Okay, so that's one of the rules you have. If you're a partner, you go out and get a loan on behalf of the partnership. You're acting on behalf of the partnership. So the other partners can't argue with him. He's acting in his own capacity. So that's indemnity, payment of interest, property rights, asset rights. There's all kind of general stuff in the UPA. But our concern here in this chapter is the partnership agreement. It's the partnership agreement. And that's what covers income. Income, salary payments, interest payments. It's the rules of bringing in new partners, retiring old partners. Perhaps someone dies. What's the rule? What do we do? Because every partnership is different. Every partnership is different. So income will vary, salary, interest, bonus, how they bring new people in, how they vote. That's all in the agreement, okay, for that partnership. So all we care about is the partnership agreement in this course. Okay. So a partnership. So the thing with a partnership is that at least someone has to be responsible for the liabilities. At least one person. Okay. The rest can be limited partners. That means their losses are limited to their investment. Okay, so they're limited partners. But every partnership must have a general partner who has to pay the debts the partnership has beyond the investment. Okay, because someone has to be responsible for that. So that's the general partner. And a limited partnership has one general partner and limited partners who only lose their investment. That's all they lose. Okay? So there's three types of companies. LLC. Income flows through to the partners. Okay? And owners can be corporations. Okay? But the thing with LLC is that the owners, their losses are limited to their investment. So if you want to start a company, do an LLC. Because your losses are limited to your investment. Okay? But there must be one general partner though. LLPs. All the CPA firms are LLPs. Okay? Again, there must be one partner responsible for all the debt. But and all the rest can be limited partners. Okay? No corporations, and because of Ernst & Young, you can't sue the firm because of one partner, negligent partner. So Enron was at Houston. Enron. They sued Ernst & Young, and they won.
Enron did?
No, the investors did.
Oh, the investors.
Because the audit firm didn't catch any of Enron's mistakes. So the new rule is now, if you have a bad partner in one office, you can't sue the whole firm because of that one partner. Okay? So a negligent partner can't be sued, but not the whole firm. It's since Enron, because the investors sued Ernst & Young. Was it Arthur Anderson?
This thing is Arthur.
Arthur Anderson.
Arthur Anderson. Yeah.
Arthur Anderson. They sued the whole firm because of one bad partner and one bad office.
And that was Arthur Anderson was the bad partner?
They've gone.
I mean, he was.
No, it's the person in the Houston office, I think. I'm not mistaken. Okay. And then you also have MLPs. These actually trade on the stock market. But they have special requirements that most of their income must come from resources, commodities, or real estate. Okay? But for our purposes, we're going to really look at probably LLCs is the most common type, and even limited partnership. That's what we're going to focus on. These are different types, LLP and MLP. But for our purposes, really, we're down here, limited and LLC. Okay, so what's the big difference with partnerships? In the equity section, all we see is the partner's name and their balance. There's no shares, no preferred shares, no paid-in capital, no retained earnings, there's nothing. It's just X, his balance, Y, balance, C, balance. Okay, just one number. And that's their ownership in the firm. Okay? And those accounts are created when we start the company, start the partnership, and then we add to it every year from retained earnings. Okay?
So retained earnings is non-existent.
There's no retained earnings because the partners own the firm. So if we have retained earnings of $100, and we have 3 partners who own the firm equally, they get 33, 33, 33. We debit P&L and credit their capital accounts by 33, 33, 33. Just like retained earnings you would. But they split retained earnings. They split it amongst themselves in their accounts.
Oh, so that one journal entry, my CPA, I mean the CPA for a company that when at the end of the year he splits it, that's what he must have been doing.
Right, because there's no retained earnings. Whatever the net income belongs to the partners. If there's 2 of them, they split it, whatever their rule is. There's no retained earnings. It goes straight to their accounts. So we'll see that, okay? We'll see that. Also, if there's losses, we debit their accounts. We credit P&L, debit equity, which means debiting their accounts. Because they take the hit if we lose. Okay? And same process, we close out P&L and allocate the balance to their accounts at year end. Okay? Same process. If the partners take out cash, it's not an expense. People get confused by this. It's credit cash, debit equity. Just like if they're putting money in. We debit cash, credit their balances.
So like an owner's draw?
Owner's draw. If they take out cash, it has no income statement effect. They can credit cash and debit equity. That's the entry. They can take out as much cash as they want if there's rules on cash or withdrawals. But it's up to them. It's their balance. Okay? So cash withdrawals, even cash payments, we debit cash, credit equity. They take out cash, credit cash, debit equity. There's no income statement effect on cash withdrawals or cash payments. Yes.
So how do you know how that cash is being used?
We don't.
So when they're audited, it doesn't matter?
No. It's their balance. If my account is $100,000 and we have $10,000 and I want to take out 10, I can. My balance is now 90. It's their balance. We have they can take out money for any reason whatsoever. Most will have rules like, okay guys, we need cash for the business. Let's all take out $10,000 a year, that's it. Maximum. Or $20,000 a year, or $50,000.
Do they ever have a restricted cash account so that they can track the difference between that? It just seems like it would get confusing.
No, because every cash withdrawal hits their account.
Yeah, so then they can just look at it from that side.
Right.
Okay.
Is it petty cash or something separate?
No. Because many partners don't get salaries. They just get net income.
Well, what if a partner gets the salary?
Some do, if they
I mean,
work
like
at the
this.
partnership. Well, we'll get to it.
Oh, sorry.
But some partners don't work, they own, say, 10%.
So
But every
then-
year their account goes up or down based on net income.
Yeah.
And they'll say, at some point, I want some cash out of that thing. So give me some cash. Okay? The important thing is cash entries and cash payments are not income statement. People make that mistake all the time. It's not income statement. It's just purely balance sheet. Okay, well, we'll get to it. Okay? All right. So let's do formation. There are 3 types: simple, bonus, and goodwill. Okay? So simple method is the easiest. The partner's balance is exactly what they put in, which makes sense. Okay, so here we have an example. Prince puts in 30,000 cash. Quinn puts in a building. So perhaps, I don't know, well, it's a partnership, so I guess they need each other. Prince needs a building, Quinn's got one. Quinn has no cash, but Prince has cash. So it's a partnership, they agree to do business together. So Quinn's building, fair value is 75 and mortgage 35. So Quinn is putting in 40,000 net. Prince putting in 30,000 net. So their balance sheet will look like this when we start partnership. There's the cash, 30. There's land and building, 75. There's the mortgage, 35. So what are net assets of this company? What are the net assets?
Your land and
105.
105. Net assets?
70, yeah.
70. Less the debt.
Alright.
Remember? So net assets equals equity. Assets take liabilities is net assets, which equals equity. So they put in 70 as a partnership. They're putting 70. And simple formation, Prince gets 30, Quinn gets 40. That's it. That's the opening balance sheet. You see how the equity section, just 2 numbers. Prince balance and Quinn balance. That's it. So that's simple method. You get what you put in. That is simple. Prince put in 30, he's on 30. Quinn starts off at 40, he put in 40. Or she. Okay? So that's simple. All right. So that is simple. The next one is bonus method. So nothing changes. Nothing changes, but Quinn says, you know what? I'm happy to start 35-35. That's what they agree to. Quinn says, I'll start, and Prince, we'll start 35 each. 35-35. Nothing changes here. Net assets haven't changed. They're still putting in the same things. But they split it 35-35. That's bonus method. Why is it bonus? Why do you think?
One of them gets more than what they actually.
One gets a bonus. Prince gets the bonus. Prince puts in 30 and starts off at 35. So Quinn has given Prince 5,000 in equity to start equal.
So you're saying they put in their separate amounts, but they agree that they'll be equal partners?
Right.
Okay.
So Quinn has lost 5,000 and Prince has gained 5. So Prince got the bonus. Okay. So why would Quinn do that? Why not start like this? Why would Quinn give a bonus to Prince? Or give him 5,000 extra start?
Maybe
That's
because,
just, yeah.
I was gonna say because then they share equally in the liabilities as well.
No, that's different. That's different.
Okay.
Allocation of income is different. It's just the opening balance sheet.
That could have to do with them sharing equally in the distribution.
No, again, that's income allocation.
Okay.
That's different.
Just
This is the
simplify.
balance sheet.
Just simplification.
No.
This is goodwill for you.
This is pretty simple. So is this. But why is Quinn willing to give up 5,000?
It's just goodwill. The other partner has something else that he can get out of the partnership.
Right, you're on the, it's not goodwill, but you're on the second was right, the second sentence was correct. Perhaps Prince is bringing a skill. So perhaps Prince is a mechanic, and Quinn's got the building. Prince has got cash and he's a mechanic. And, oh, not building. And perhaps Quinn has a garage. So Quinn was like, you know what? You're a mechanic, you have a skill. I'll give you 5,000 because you bring your skill. All I have is a garage. So perhaps Quinn is saying, you know what? We should start equal because you're bringing cash and something else that I think is worth 5,000. Make sense?
So under bonus method, they always share equally or
No. This could be
any other way?
this could be 60-10.
It's whatever they decide.
Whatever they decide. It's their choice. 60-10 means Quinn is like, Crockett Prince is an expert in something. It's like Prince is an expert in something. So Quinn's like, I'll just take 10. You run the show. You have the skill we need. All I have is a garage. Okay, so it depends on their arrangement. It could be 60-10, 50-20, whatever they decide. But they're splitting the 70, basically. Bonus method is also called book method because we're not changing anything on the balance sheet. It's still, there's net assets, equity is the same, we're just splitting equity
So the
into
bonus,
different numbers.
so the bonus method is just a 50-50 split?
No, bonus method is just, we're allocating the 70 to whatever they decide to do. Right, we have equity of 70, right?
Right, because that's based on,
On what they put in.
yeah.
Equity is 70. Equity here is still 70. We don't care how they split it. 60-10, 50-20, 40-30. It's still 70. One gets a bonus, one gives a bonus. Okay, if they don't do this. Okay? So that's the bonus method. Someone loses, someone gains. But equity is still 70. Goodwill is different. Goodwill is the hard one. Not hard one, but odd. Okay, so here they split the 70, whatever they decide to do. Goodwill, this is the third one. Goodwill. Nothing's changed. Nothing's changed, but Prince and Quinn puts in 40, and they both decide to start at 40. They start at the highest number. Quinn's the highest at 40. So they say, you know what, let's just start at 40 each. I put in 40. 40 is the number for everybody. So they have created something. Because now equity is 80. Right? Net assets were 70. Equity is now 80. Because they want to start at 40 each. So we have created goodwill of 10. So perhaps Quinn is saying, you know what? You put in 30 cash, but I think the skill you're bringing is worth 10. So let's start equal, 40-40. And so they've created goodwill of 10. Or,
Debit goodwill?
yeah. Because they only put in 70, right? Net assets are 70. Now they're saying, let's start at 80. Let's start at the highest, 40-40. So we're 10 short. So who created the goodwill?
Prince,
Prince. Well, they both did, but
yeah.
Quinn is saying, you know what, Prince? I think the skill you're bringing is worth 10. So I'll give you 40 starting, the same as me.
Is that amount of goodwill limited to like the 40K?
They can start at 50 each.
So that's just like a number that they created,
So what's the problem with this?
that seems like it would be
Estimate.
It's an estimate.
yeah.
In whose head?
Yeah,
There's,
theirs.
which seems fishy.
Right. What is goodwill normally when you think of goodwill? What is goodwill when you think of
The
goodwill?
excess when you, if you like acquire a company or
Yeah.
something, which is actually an amount.
Right, when you, like here, if net assets are 70, and I think, I'll buy this for 100.
Yeah, then 30 is the
I've
goodwill.
created 30 goodwill on my balance sheet. So I'm buying it. I think it's worth 30 more. But this has just come from these two saying, you know what, let's just create this.
Yeah, 'cause they
This
get,
is not a purchase price. It's not a market price. It's nothing. It's just a number. So if you see goodwill in a partnership, where did that come from? Did someone buy it? No. We created it ourselves. So it's worthless, really. For external purposes, this is worthless. They created it. It's not a market price. No one purchased the partnership. They just created it to satisfy their equity balances. They could start at 50 each. In that case, this will be 30. Okay? So that's the odd thing about goodwill. You do create an intangible asset with the goodwill method. Bonus method is bookwill. Sorry, bonus method is book, because you're just moving around equity. You're moving the 70 around, 60, 10. You're not creating anything. But here you are actually creating something which has no market value. But they want to start at 40 each, that's their choice. And they create 10 to balance the books. Okay, it's not a purchase price. So that's the problem with it. Okay? But again, it's their choice. If they want to start here, fine. Create this, move on. Okay, but it's the opening balance sheet. As you can see, equity is just two numbers. Prince balance, Quinn balance. No retained earnings, no shares, nothing. Okay? So that's formation, three methods. Simple is what they put in. Bonus, they move the equity around. And goodwill, they typically start at the highest number, 40, and make everyone the same, and then they create goodwill. Okay, so that's formation. Three ways. All right. So any questions on that?
So at the end of the day, with goodwill and the bonus, like the net value of assets will equal the capital, and the capital is up to the partner, how the partners decide.
Yes. Bonus method, they're creating nothing. They're moving the 70 around. Goodwill, they're creating an intangible asset. Okay. All right. So here's a question. Three people. Abel, Baker, Kane, form a partnership. Abel puts in 100,000 cash. Baker, 30 cash, but experienced. And Khan's got the building and some equipment. Okay, and what do they decide to do? They decide to start off equally. 74. Well, let's just go through it first. There's the cash. 130, there's the cash. Building is 200. There's the mortgage, 125. And the equipment's worth 17. So what are net assets? Well, you can do it from here. Net assets are what? 222? Yeah. Net assets are 222. And they decided to split it equally. That's their choice. They're starting off equally at 74. So which method is this?
Bonus method.
Bonus method, because they're just allocating equity amongst themselves. This could be anything, 150, 72. It's their choice. So obviously Abel is not getting a bonus. Abel's losing 26,000. Baker put in 30,000 cash. So Baker has a bonus, 44,000. Kane put in 75 plus 17, 92. So Kane's also losing 74. So Baker got the bonus. Abel and Kane gave the bonus. Okay, but they start equally, 74. Okay, so goodwill method is different. You would make everyone 100 because A will put the highest in. So typically goodwill method, you start everyone at the same level at the highest one, which is 100. Don't have to, but that's what they do typically. You start for 100. So here's the goodwill.
How'd you get this on
Oh wait, we're saying that the goodwill method typically you start off at the level of the highest contribution. So Abel puts in 100. He's the highest, or he or she. Highest. So we start everyone for 100. There it is. 100, 100, 100. The assets haven't changed. But we've created goodwill of 78 above net assets.
So it's created based on.
Well, we have equity is 300 and net assets are 222. So we have created 78 goodwill for balance. Because these three partners want to start off for 100,000 each. Okay? So that's goodwill. We're creating something to balance. Okay? Again, bonus is just net assets. We're allocating net assets. Not creating anything. Here we're actually creating something. Because this is now 300 in equity, not 222. Okay? So that's goodwill method. And the first one's bonus. Okay. And simple would be Abel gets 100, Baker's at 30, and then Kane would be at what? 92. So that's simple.
So assuming that they're, for the goodwill method, assuming that they're all going to the highest cash contribution, the goodwill is kind of just like a plug.
It's a plug.
Okay.
It's a plug. Yeah. Because they want to start off at 100. It's a plug. Okay? So that's formation, basically. That's it. There's three methods. There they are. So this is the second part of it, is the income allocation. Okay? That's pretty straightforward. It's pretty straightforward. So they decide on salary payments, bonus payments, interest payments. It's their choice. Whatever they decide to do, it's up to them. Okay? And then they pay the salaries, bonus, interest, everything else. And then they also have an agreement on what's left. They split that equally, or 5-2-3, or 4-4-2, or 50-50, wherever the agreement is based on the remainder. Okay? So, so we assume full implementation. That means we're going to make these payments regardless. Salary payments, interest payments, bonus payments, we're going to make them regardless of income, because they're guaranteed. And then whatever's left, we allocate. Okay? So it's kind of confusing. We'll see an example. We'll see an example, or easier. Okay. So, so here's an example. We have three partners, DEF. Net income is 370 for the year. Income is 370, and they split profits equally. But D and E get a salary. Right? D and E get a salary. So full implementation means we pay the salaries first. They're guaranteed. So we give D 200, we give E 50, F gets nothing. That's the agreement. Total 250. That's guaranteed. We pay it. Income was 370. So we have 120 left to allocate. And we said they split profits equally. So 40, 40, 40, there's the 120. That's their total income for the year. Total 370. Okay? So you must make these payments first, then allocate the difference to get back to net income. Okay? So perhaps D works in the business, and E's there part of the time. F's never there, so that's their agreement. I'll work in the business. I want a salary of 200. Okay, we'll pay you. Okay.
So the balance split, the 40 is, how do you arrive at the 40?
Because we already paid 250 250.
To,
We pay, D&E gets 250 together.
as a salary expense, or
Well, I'll get to that.
a salary-
250.
That salary? Right?
It,
Yeah.
it is, but, okay. And then we have, income is 370. So we have 120 left to allocate. And they split profits equally. So 40, 40, 40. That's our total allocation. So here's another confusing part. These are not really salaries. It's guaranteed payments. That's
Like
the-
a what do they call it? If you're a corporate part, but it's not a salary, it's stipulated or something?
well, I'm not sure about that, but
But it's not like a normal paycheck, right?
I want to emphasize, this is net income, right?
Right.
We're paying out of net income. We still pay other salaries, receptionists, admin folk, the maintenance people, all the rest of it. We pay their salaries. That's part of our expenses. But this is net income. Right? It's not salary that reduces net income.
Those are just guaranteed payments that
Out
will,
of net income,
yeah.
So like a
It's like-
dividend?
if you want to call it that, yes.
This is just different ways of distributing essentially retained earnings.
Yes,
Okay.
exactly.
And this is from the partnership agreements?
Yes.
So,
But importantly, this is not a salary expense. We're giving, this is part of, we're allocating net income. Right? So we already have income, we have expenses, we have net income. We're paying out of net income. This is not part of net income. This is not lowering net income. We're paying out of net income. Right? Because we have income, expenses, then we have 370 left. And that's how we allocate it.
so you initially allocate the salaries as like a dividend, and then you get the 120, then they're split equally?
Yes.
So the
Profits
120
are split equally
Yeah.
after the guaranteed payments.
Okay.
That's guaranteed, pay it. Then we allocate the difference, and we should get back to net income. Right?
I mean, the net income before the guaranteed payments.
Yes. Because we're allocating net income. That's what we're doing. Who gets net income? Who gets it? That's the arrangement. Okay? So here,
Out of curiosity, how would salaries be recorded in the books? What would be the journal entry for those guaranteed salaries? So, I mean, credits cash, what would be the debit? Just out of curiosity.
okay, so use the spreadsheet here. So net income is 370. Okay. So what is the entry we're talking about?
The salary ones.
Yeah, so what is it? What do you think it is?
So the credits cash.
Is it?
I mean, the
We're
credit.
closing out an income statement.
Yeah, no, because the credits cash because it does. This won't affect the balance sheet.
Oh, yeah. You're all over the place there.
Yeah, credit.
This is not cash, and it's not, it is balance sheet. So net income is 370. Okay, take a corporation. If net income is 370,
Yeah, it's close.
and we close out the year,
Mhm.
what do?
The credit would be retained earnings.
So we would debit P&L,
Yeah.
370. Oops. Fix this. Number. What's that? What's the 4? Oh, it's percentage. Oh. It's all a mess. Okay, okay, so if it's a corporation, we would debit P&L 370, and where would the credit go?
Return your earnings.
Right. So
Is
is
retained
cash
earnings-
involved?
No, because retained earnings, this is a lifetime communications P&L.
Okay, so it's the same principle. The partnership has net income 370. We close up the P&L. Okay, the same entry. Who gets the 370?
Capital.
Capital accounts. We had D, we had E, we had F. F gets 240. E gets, 90. And F gets 40. Gain has nothing to do with cash. We're closing out an income statement, and that's the allocation.
Okay, I thought we meant salary as low payment. Okay, I took that.
Okay, you guys get that?
So the salaries just increase their capital. Doesn't mean they cash it out.
Again, it's guaranteed payment out of net income. Salary is the wrong word technically,
Yeah.
because salary means expense.
Yeah, for
This is
me,
not
too,
expense,
it's
they're
like,
guaranteed
wait a minute.
payments, but they call it salaries because it's just convenient, but really it's guaranteed payments out of net income. And that's what we're doing. The
So
370 goes to DEF this way.
when you say that that goes to capital accounts, are you saying that you're reducing the amount of money in the equity accounts?
We're increasing it.
Oh, okay, so you're just basically moving it from retained earnings to equity.
You could say that.
Okay.
Well, we're closing out an income statement and crediting their balances, not retained earnings. It's the same entry basically. We are increasing their equity accounts, just like we would increase equity if we closed out income statement at 370. Okay. Their accounts are replacing retained earnings. Does that make sense? Yeah. So retained earnings is split into their balances. That's more sense. Retained earnings is really their individual balances, what they own. Okay? So that's what we're doing. The next one's more interesting. Again, same situation. Guaranteed payments, this is the wrong word, we should use that really. Guaranteed payments, 250. But net income is only 160. So we have to allocate a loss of 90 to get back to 160. Because of the guaranteed payments, we must, even that's wrong as well. Because we're not paying anything. It's not a guarantee, it's not cash. It's a guaranteed allocation of net income. How about that? Does that make sense? It's a guaranteed allocation of net income. No one's paying cash here. Okay, probably a better word. So D gets 200, E gets 50, 250. We have to allocate a negative 90 to balance. They split the losses equally and profits, 30, 30, 30. So now their allocation is 170, 20, and F actually goes down by 30. Okay? Does that make sense?
So,
Guaranteed allocation of net income. Nothing to do with cash.
so it's the net income before the net income.
So in this case, so you can imagine your journal. In this case, we have net income is 160. We clear P&L. D gets 170 of it. E gets 20. And F goes down by 30. Okay. Okay, that's what's happening now. We're We close our income statement. D&E, they're better off. F goes down by 30. Okay. But we're still closing out income statement and crediting equity for the 160. Okay, that makes sense? It's the same entry that we close out, it's just the same. Corporation, debit P&L, credit equity. We're doing the same thing, except we're hitting their accounts directly. Okay. So is that making sense? All right. Remember, this is net income. This is not salary expense. We're paying out of net income. Who gets net income? That's what we're deciding. Who gets net income? All right, so watch out for this. If there's a loss, you allocate. Make sure you come back to your net income. 370, 370, 160. This must be 160. You must allocate net income. So make sure this equals what the question says. Otherwise your allocation is wrong. Okay? You must come back to net income. 160. Okay, so that's guaranteed allocation, payments, guaranteed. They also get guaranteed interest. Okay? They can get interest allocation as well, based on their capital balances. So the higher the balance, the more interest they get. Okay? So it can be simple. It can be simple based on opening balance, or it can be weighted average. Okay, it depends. So here's a weighted average one. If they decide, well, here's one partner. Same as the shares weighted average calculation, exactly the same. This partner had 60,000 for 2 months, so that's 2, and then 260. This partner put in cash to the partnership. And they had 260 for what? 6 months, and then they took out cash, so they had 240 in there for 4 months. So you multiply across, divide by 12. This partner's average balance all year was 220. So that partner will get 10% of 220, or 8%, or 5, whatever they decide to do. So that's weighted average. I think the shares one divided by 12 now, divided by 212, 612, 412. Or you just times by the months, then divide by 12 at the end. Same thing. Okay? So this partner's average balance was 220. So the interest allocation of this partner is based on the 220. Okay? Again, they put in 200,000 cash into the partnership on March 1. So that's debit cash, credit equity. Okay? They took out cash, 20,000. Credit cash, debit the account. No income statement. Okay? So there's a harder one, a bit harder. We have these, again, the wrong word, salary, guaranteed allocation. 150, 350, and 300. And Vickers gets a bonus of 10% on net income before the allocations, over 1 million. Okay? And we all get 10% of weighted average capital balances. And then whatever's left, they split 5-3-2. And income is 1.5 million.
Yeah, after the salary payments, right?
No, net income is we're allocating 1.5 million,
Okay.
and that's how we're allocating. Right? This is not. This is all part of net income. Right? So that's the rule. So let's look at it. See how it looks. Okay. So there's the guaranteed payments or allocations. 150, 350, and 300. That makes 8. Okay. Vickers gets a bonus, 10% over 1 million. So 10% of 500,000 is 50. So we'll give Vickers the 50. There it is. Interest I'll come back to. There's the interest allocation. Total, 994. Whatever we decide here, 994. So we have to allocate 505 to get back to 1.5 million. And the 505 is split 532. And that's their total allocation net income. Okay, so we have salaries, a bonus, an interest payment or allocation, total 994, 505 to allocate to get to 1.5, and there it is. Okay? How do we get this? It's weighted average, it's 10% of weighted average. So I worked out one of them. I think Thomas, I worked it out. So there's Thomas's balance. This is what Thomas did all year. 690 starting, then he had 660 for 3 months, took out 30,000, took out 30 more in July, took out 30 more October, then took out 180 in November. So Thomas' balance went down all year, gradually. That is 3 months, multiply across, divide by 12, average balance was 650. And 10% of that was 61.5, and that's where this one came from. Okay? It's the interest on the weighted average. And you will work that out for each partner. Okay? The important thing is you are allocating 1.5 million. That's pretty straightforward. That's guaranteed. You give them that. You might have to work this out, if it's average or starting. It could be starting balances, easy. It's 10% of starting. Okay, good, easy. Put it in. And then allocate the difference to get to net income. Okay, does that make sense? Okay. All right. So there's Thomas. So any questions on so far?
How'd you calculate the 50K for Vickers bonus?
Yeah, because we say
Yeah,
Vickers gets 10% on net income in excess of 1 million. Net income was 1.5. So Vickers gets 10% of 500,000, which is the 50. Okay. So this is pretty much okay. Well, how are we doing so far? Does it make sense?
yeah.
It's not hard. It's no accounting really. It's a spreadsheet.
Yeah, just the thing I have to watch out for is the salaries thing. Just, I don't know, it's just instinctively you think expense.
Right. It's not. It's guaranteed allocation.
It's a guaranteed allocation
Of net income.
before the net income allocation.
No, it's
Yeah, because
out of the same pot.
yeah, out of the same pot, but they,
Yeah.
you know, because at the end they're allocating that plug figure to make the plug figure to make it equal 1.5 million.
Well, this is the plug to get back to here.
Yeah.
But these are guaranteed allocations.
Okay.
You put these down first, then whatever's left, you have to plug this in to get to this. And this could be negative to get to this.
Okay. But then they allocate on their rule, the 50-30-20 rule on that plug figure?
Yeah, this is the allocation, 532.
Yeah, but
The
first you
profits.
have to take into account the other stuff first.
Yeah. Remainder is split 532 after the guaranteed allocations. Okay? Alright, so that's the income allocation basically. So you can form a partnership, simple, bonus, goodwill, 3 ways. You can allocate income. That's about hard as it gets. Okay, that's about hard as it gets. Okay, so if you can do that, you're in good shape. All right. Okay, so let's carry on. There's the average. Okay, so this is, we're talking about this now for a while now, we must distinguish between what hits the income statement and what hits the balance sheet. Okay? So again, all these allocations out of net income, we close P&L and hit their balances. Okay? Any cash withdrawals or contributions are balance sheet only. Debit, credit, cash, debit, credit, equity. Right, cash is no income statement effect. Right, so let's look at it like this, for instance. So let's look at those same people, Thomas, Vickers, and Underwood. So this is the income statement, right? This is the income allocation. We can also look at the equity accounts, the roll forward. Let's look at their accounts. So that's their account, their equity account. This is what happened. They started off here, and there's the Tom's example, 30, 30, 30, 180. Underwood put in 100,000, good. Took out 18. Vickers took out 12. It's their choice if there's cash around. Okay. Here's the income allocation. Here's where we close our income statement. And we increase their accounts by the 1.5. This is the equity entry. Close our income statement and increase their accounts. Okay? There it is, 1.5. And then they took out 30,000, 18, and 12. Total 60. So their closing equity account is 2,670. Okay? So you can see where this now, this line, we close out net income, and then we just increase their accounts at year end. And they take out cash, put in cash. That's balance sheet only. Okay. And so that's the schedule of capital accounts. Okay? So you can see where this now ties in. You can see where this now ties in to this. Okay? And all I'm doing is this entry basically. I'm just doing that entry. Close out income statement and credit their accounts, increase their accounts. That's what we're doing here. There's the accounts. There's the income allocation. More cash taken out. Closing equity, 26.7. Okay? So that's as hard as it gets. Okay? So the important thing to know is, can you form a partnership? That helps. Form the partnership. They might have income, right? Can you work out this kind of thing for a year? And then transfer these numbers to their balances, like this. And they may take out cash, and that's closing balances. Then you have year 2 income, and do the same thing in year 2.
Does this apply to LLCs too?
This is, yeah, same thing. They're all partnerships. Okay. All right. So here's an example. Oh, one more example. Okay. This makes sense to you guys?
Yeah.
Because they're taking out cash, putting cash in. It's just a balance sheet. This is the only income statement line right here. Income allocation. Okay. Let's do one example. The last one. Oh no. We'll keep going. So here's an example. Well, the same people from Review 1. So that was Abel, Baker, and Abel, Kane, those 3. So they started off here. Bonus method, 74, that's their opening position. And now they have a year of income. So what happened here? There it is. Abel gets a bonus of 15,000, sorry, 50% of capital balance, start of the year. And that was 74. Okay. Baker gets a payment, guaranteed allocation of 80, and 10% bonus income of 100. Kane gets also 8% on opening capital, plus salary of 40, and the rest is equally divided. Okay? Again, the wrong word, it's not salary, it's again allocation. There it is, salary or allocation. There's Baker's 80. Kane gets the 40, yeah. Bonus 77. Where did that come from? 10% over 100. So 177, 7.7. There's the bonus. Interest, able. That is 15% of the 74. Opening balance. Right from here. That's here. Opening balance 74. That's 15%. Kane gets 8% of the 74. 59. Add across. And that means we have to allocate 32 to get back to 177. And the 32 is split, we're told, equally. So 10, 10, 10. That's the income allocation. Okay? That's about as hard as it gets. Okay? This time it was easy because it was interest on opening balances, not the weighted average. A bonus, some salary payments, there's the difference, 177. Okay? Again, it's not really accounting here, it's more just calculating income. Okay? And then, so their capital accounts, how would that look? Well, let's start out with 74 each. And then we close that income statement, 21, 98, 56. We give it to them, 21, 98, 56. Looks like they took out cash, 87.40. That's their choice. And there's closing equity, 271. Again, that's income statement. This is debit, credit, cash. Well, credit, cash, debit the balance. Okay, and that's the closing. Do the same thing next year. All right, that's it. Really. So any questions on formation and allocation, and then also transferring the balances to this kind of schedule and how the closing balances? Yeah.
So the order is always salary, bonus, interest. What can it be different?
Can be different, doesn't matter, because they're all guaranteed.
Oh,
Right, I write it salary, bonus, interest, but they're guaranteed allocations. So you must do all three. You must do all three. Doesn't matter which order, doesn't matter. And then whatever's left you allocate. That's the, okay. But that's, the questions will revolve around this. Salary, bonus, interest, the remainder, allocate net income, close it out, add to their balances or reduce balances if there's a loss. There's opening, allow for the cash taken out or in, and that's their closing. And they start again next year. Okay. All right. So that's pretty much the stuff I'll be testing on. Is formation, allocation, and the capital account schedule. Okay. Let's just do. Do this quickly. A new partner. This is pretty straightforward, actually. So let's say we're here right now. We have assets, liabilities, 140, 50. That's where they are right now, these three partners. That's where they are. That's the balance sheet. That's the end of the year. And then, let's say Crow sells to Findlay. Crow says, I'm done. I'm leaving the partnership. And Finley says, I'll buy it. I'll take over. What happens is Finley pays Crow $45,000 privately and just takes his share of the partnership. Right? And this is Crow's choice. I guess they're in agreement, obviously, it's part of the agreement. But Crow is done, he's selling his share. Fine. He'll take the cash from Finley. I'll just put Finley's name here. Done. So Finley takes over the $33,000 that belonged to Crow. Right? So it's not Finley's not paying the partnership. Finley is paying Crow directly for his share and just takes over his account. His balance of 33. Obviously, Crow's made money. Crow's made $12,000. But the partners don't care. Well, this is one method. They say, fine, carry on, sell it. We'll bring in Finley instead of you. But the payment's made outside the partnership. This is one example. Okay? Just a name change on the balance sheet. The cash is outside the partnership. There it is. We debit Crow, 33. Create Finley, 33. Done. No more entries there. So what if Grogan says, you know what? Grogan wants to buy 25% of the partnership. He wants in at 25%. And they'll say, fine. Again, Grogan will pay the guys outside the partnership cash, and they'll give up 25% and bring him in. It's kind of odd. Yeah, odd because it's outside the partnership. Right? It's outside the partnership. So they reduce their balances by whatever, it's their choice, and give Grogan 22.5, which is 25% of the partnership. The partnership was what? 90. Equity was 90. So 25% is Grogan 22.5. Okay? They'll go down with 25%, go down, and give it to Grogan, and he's there. But the cash was paid outside the partnership. Kind of odd, but okay. It's kind of
So
odd.
probably so in the last example, so pretty much Crowley got a gain of 12K privately
Privately.
off the books.
Off the books to go away. And Finley comes in and says, it's kind of odd, but this is one method of doing it, where the cash is paid privately and they just bring in Grogan at a certain point. And they'll have a new income agreement now. New allocation agreement. Because now we have Grogan in there. Okay, again odd, but it's just the way it is. This is the other one, goodwill. Okay, so we have, back to here, this is the balance sheet. Net assets are 90, right? Are they? They're 90, net assets, and that's the allocation, 90. So Grogan says, I want to buy 25% for 28,000. Okay? So 28,000 is 25%. So what is the whole partnership worth? If he's buying 25% to 28.
25% of each of the.
Yeah. So it's 4 times 28. Right? That's what is that? I'm terrible at math. 28. 28 times 4.
72.
112.
112. Sorry.
Because Grogan is buying 25% for 28,000, that means the whole thing's worth 112. But we only have 90 on the books. Now we have real goodwill. Because someone is saying, you're worth more than 90. Really, you're worth 112. Okay? So we have created goodwill, $22,000 because of Grogan. We have real goodwill. It's a market price. Because Grogan's buying 25% for 28,000. So the whole thing's worth 112. So we have okay. So therefore we have now goodwill of 22. we have real goodwill of 22. So who gets the 22, do you think? We debit goodwill and must credit something.
The capital,
Who gets it?
all of them?
The three partners who form the partnership based on income allocation, 532. So we book it. There's the goodwill, and there's the 532 split. Okay? And then we add the 11 to Arthur's total. Arthur was at 31. We add 11 to him or her. That makes 42. Then take away 25% and give it to Grove. We do that for each of the partners, and we debit their accounts by this much, and there's Grove at 28. Okay? This part's a bit confusing. Okay? But this is the new partner admission. Okay? We won't do retirement, it'll confuse you even more. Okay? But just be aware that when a new person comes in, there's three choices. One, just change the name on the account. The cash is outside the partnership. Or the second one, the new person pays everybody outside the partnership, and they lower their balances and bring the new person in. And the third one is they create goodwill and then book the goodwill based on income allocation, and then each reduces their new balances by 25% and give it to Grogan. So therefore, he paid 28, which means he starts at 28. Because we create a goodwill of 22. Okay? Alrighty. So that's it for partnerships. Okay?
So,
That's it. Again, the important things are, the new partners, that's okay, you can learn that. But the crux of it is, really, is form partnership, you know, simple, bonus goodwill, make sure you form the partnership. Can you allocate income, net income? Something like this. Can you allocate net income? Close it out, and then, that's a bit complicated. Something like this. Close out income statement. Increase their account or decrease. Then have the cash entries. Closing balances. They do the same thing for year 2. Don't worry. Okay. So if you have any questions, please contact me. Alrighty. Okay, let's take a break then we'll do the recap.
So it's possible for partners to lose on these?
Yep.
And my dad mentioned